Bloomberg Audio Studios. Podcasts, radio, news.
Hello, I'm Caroline Hepker, Bloomberg radio anchor, and I want to tell you about the city's verdict on the Labour government's first 100 days in office. Voices from across private equity, venture capital and finance say that whilst they appreciate Keir Starmer and Rachel Reeves's rhetoric on economic growth, they're still waiting for them to deliver. UK investors and business leaders who've been speaking to me in the last few weeks are sounding a bit unimpressed and perhaps even frustrated. Let's start with the Phoenix Group, which is the UK's largest long-term savings and retirement provider, and their Chief Investment Officer, Mike Eakins. I asked him what he thinks the new UK Labour government has been able to do and to deliver so far.
The UK government have been very clear that economic growth and economic sustainability is an absolute priority for the government. And that will bring about a path to greater prosperity and fiscal sustainability. Phoenix, we absolutely welcome that. And as the UK's largest long-term savings and retirement provider, we absolutely stand ready to work alongside the government to build out key requirements for that economic growth.
Has there been evidence that the idea of crowding in investment into the UK is actually working?
Significant progress has been made in the recent weeks. And we've got the upcoming investment summit, and that's a really important opportunity to bring together all the key players, domestic and non-domestic investors. And our ask is that the government should be really bold in outlining what it wants to achieve from that investment summit.
The government has been without an investment minister, though. That's usually a key figure meant to drive inward investment. Is that a missed opportunity? As you say, the all-important investment summit is coming.
We don't think it's a missed opportunity. Investing in the UK and the attractiveness of the UK isn't down to one single individual, in the government or outside the government. We're sure the appointment of an investment minister will come in due course, but that should not hold up progress.
What's been the biggest win, in your view, in terms of this new administration in economic and market terms, as far as you're concerned?
It is the transparency and ambition to really prioritise economic growth. Recognizing that the government, as indeed many other developed market economies, are in a tight spot from a fiscal perspective, and working with the private sector, coming up with pipeline of investable assets that long-term investors such as Phoenix and other pension funds, insurance companies can invest in, we think is absolutely key.
Have Labour been too pessimistic on the economy and caused a hit to sentiment and therefore to the investors that you're talking about?
The fundamentals of the UK economy are absolutely sound. I mean, the UK economy, is expected to grow at just over 1% this year. That's in contrast to our European neighbours, where economic growth is not so robust. We now have political stability. And so with political stability combined with the rule of common law, amazing sectors like venture capital, early stage growth. So we think that the fundamentals are absolutely sound.
Thinking about the budget, the most dramatic point maybe of the first 100 days was the Labour statement around finding this £22 billion black hole in government finances. Do you expect an austerity budget? How do you think that hole might be filled?
Yeah, I think it's widely recognised. Again, the UK, like many other developed market economies, is in a tight spot from a fiscal perspective. Debt to GDP at the UK and indeed with many of our developed market peers are at all-time highs not seen since the end of the Second World War. The main problem facing the UK economy over the past 15 years is chronic low productivity since the global financial crisis of 2008. In order to raise productivity and to create a resilient growing economy, the UK does need a substantial capital expenditure in key areas such as housing, infrastructure, energy. What we would say to the government is the private sector can partner with the government to achieve significant long-term investment in those areas of capital expenditure, noting that the UK, like many other developed market economies, is constrained from a fiscal perspective.
There are high expectations in some senses for the Labour government, despite the kind of difficult backdrop in the UK. Do you think that they've managed to deliver at least on the start of that down payment for the UK?
Again, it's about delivering that economic growth that delivers that path to greater prosperity and fiscal sustainability. And I think, again, there's been areas of focus from the government which should be applauded, as they will give us that path to strong economic growth. Some of the announcements that we've heard on planning is really, really key. I mean, there's today in the UK has a chronic housing shortage, and more can be done to alleviate that housing shortage by creating and building new social and affordable housing. And again, the Phoenix, we've invested, billions of pounds in social housing, social and affordable housing in recent years, and we stand ready to do more of that. And building that new stock of affordable social housing, that is economically stimulating in of itself. But it also helps on other key aspirations that the UK has as a nation state, and that Phoenix also has as a large corporate in the UK, which is the move to carbon net zero. So yeah, absolutely. The initiatives around planning and increasing the building rate of new homes to alleviate the housing shortage, it will be an economic stimulant. It will be good for the path to carbon net zero. And I think that the second point we'd note in delivering that path to strong economic growth is investing in key drivers of growth and in technology and in AI. Hopefully we'll see more of this come through from the investment summit. But it should not be lost on people that the UK has 10 of the top 25 globally ranked universities, and we absolutely need to be harnessing the intellectual property and the new technology that's coming from that.
That was the Phoenix Group CIO Mike Eakin saying it stands ready to invest more, but calling for bold action from this government. Now, 100 days, of course, is a bit of an imported US idea, given that it doesn't have much meaning in the UK's parliamentary system. But the Labour Party used it as a yardstick for delivery on various of their legislative plans in the run-up to the election. And given the need to improve economic growth in Britain, which looks to be cooling according to the latest monthly GDP data, time is of the essence. So I was speaking to the veteran investor Anne Glover, co-founder of Amadeus Capital Partners. She's just the sort of person that Labour courted ahead of their landslide election victory. She's also a member of the Bank of England's Court of Directors. And so I asked Anne Glover whether the government has delivered on its first big pledge of bringing stability to Britain.
It's too early to tell on stability. Stability means a much longer time period than we've had. But, I mean, they have, I do think the markets have reacted reasonably calmly. They've stayed very clear about things like Bank of England independence and, their pledges on the taxes that they're not changing. I think that there's a lot coming in the budget that we don't know about. There's quite a bit of speculation, and there's so much speculation, I don't think we have a clue what's actually going to land. So I think it's too early to tell. I think that will be a big moment. I think if they're going to do their work thoughtfully and well, they needed the time. So I'm personally giving them the benefit of the doubt. I think the National Wealth Fund, at least the commitment to infrastructure, is positive and needed, and that was announced quickly but not yet fully implemented. So I think we've got to wait and see how that will pan out. Infrastructure is clear. I think the equity side is really unclear yet. And I do think, and I hope they continue to support the British Business Bank and they attract foreign direct equity investment, not just project investment into the UK. So this investment summit is going to be a really important occasion because it's sort of a continuation of what the last two were under the Tory administration. They were very high profile, and they did announce some very big deals as a result of it. It'll be interesting to see if Labour is able to do that.
The investment summit, though, doesn't seem to be well timed.
No.
Because it's right before the budget. What can the government really get done or get from that event?
I think there's a lot of work that goes in preparation, and I hope that there are some big foreign direct deals that are happening that could be announced at that summit that are not dependent on the budget. But I agree, it's not great timing.
Have Labour been too pessimistic on the economy as one of those early tests? Ooh, that's a big yes.
Yes, I think so. Absolutely. I mean, of course, the economy isn't growing fast, but it's stable, and it wasn't stable for the last 4 years. No, I mean, I think it's not particularly due to them. It's due to macro factors. It's the fact that inflation has been subdued, interest rates will come down. There are worries about, obviously, conflicts around the world that are pretty awful, but in general, most of the economies are now bottoming out and beginning to recover, and that cycle is going to happen almost no matter who's in government. So I do think they're a little bit more pessimistic than they need to be.
The tax changes that could affect
Yeah.
the non-doms and private equity in the form of carried interest, do you see that threat forcing talent out of the UK, the non-doms issue and the issue around private equity taxation?
At the very senior levels, I do. I think some non-doms will leave. Have
you seen non-doms going already?
Not recently, but even under the Tory announcements, yes. There are global citizens who can cite themselves anywhere, and some will leave. It's a small number. It's people with incredible wealth and incredible flexibility. So, that is one of the consequences. Is it going to be droves? Probably not. I do think there are a lot of people thinking about it. It's not going to affect venture as badly as it will affect private equity, because private equity tends to be a global market. It won't be everybody, but it will be a few high-profile people for sure.
Do you think that the government will alter its budget plans on the basis of those concerns, or that it should?
I hope they will be sensible and phase in or manage the taper of whatever is being implemented so that people don't have to suddenly relocate. And that would be true for any change. I would basically caution against cliff edges. They're really bad for any industry.
What do you think has been the biggest win of the new government?
Gosh, that's an interesting question. I think Keir Starmer handled the riots reasonably well, actually. I don't think people expected him to be so tough on law and order. That's always been a Tory positioning, and obviously it went into his power alley of understanding the law and how to handle it. And I do think that was noticed both domestically and globally, and it characterised him as a little bit more of a tough leader than just a sort of slightly grey, not quite sure who he is. So I think that was a small win, important win in terms of media and domestic profile. I don't think there's been a major economic win yet.
Amadeus's Anne Glover there. So still giving the government the benefit of the doubt, but wary of budget cliff edges. Indeed, warnings about rising taxes in the budget is spooking investors. Lloyd Lee is managing partner and co-founder of U Capital, which has invested £2.5 billion into the UK since 2010. His business is behind the redevelopment of Olympia in West London and is planning a big new redevelopment, the Camden Film Quarter in North London. I kicked off our conversation by asking whether U Capital is planning new investment in London as a direct result of the new Labour government.
Absolutely. If you look at U Capital for both macro reasons but also London reasons and real estate reasons, we see strong positive fundamentals in our business where we are now inclined to step forward and invest more.
U Capital is involved in one of the biggest regeneration projects in London at Olympia. So I'm interested to hear that you are so positive about increasing investment. How concrete are those plans really?
We were long London in 2015, 2016, when we were already at a unique precipice in the history of the country. And we acquired Olympia and are now investing 1.3 plus billion sterling into it. And that's all post-Brexit. So even before today, we were long London. The fact that we've now gone forward and launched the Camden Film Quarter, we've obviously acquired Shepherd's Bush Mark, which we're now turning into a revitalized market with the original market traders, but also investing heavily into the life sciences in partnership with Imperial College London, means we are genuinely investing more into central London.
What would you like to see from the Labour government to do in order to sort out the planning system and make the UK more investable?
If you look at the history of where we've been since 2015, 2016, you could probably say we have been one of the key leading private sector investors who partners with local government. And so for us, the fact that you now have Labour at the council level in many cases, certainly Labour at the mayoral level and at the central government level, we'd really like to see continued increases in the coordination between all levels of government. We are already starting to see those signs, which is positive. And I think what we're finding at the local level in London is people are just cracking on with business and growth. And that for us, again, is another reason why we're long London.
How challenging are planning delays really when it comes to arranging financing for the kinds of projects that you're doing, you know, as you say, in the billions?
It is difficult. There's no question about it. The question is, what are we going to do about it? Because you cannot, on the one hand, allow progress to be impeded by the organizational structure of the system. But equally, I think it'd be dangerous to just get rid of the system because you think, well, I'm just going to pave the way for anything I want. We cannot do that either. Any vision in London has to be public-private together as one.
How concerned are you then about the budget? This is something also that we've reported on extensively in terms of the UK's status as a magnet for wealth and for investors. Is that at risk, given the concerns around taxation, the potential implications for the attractiveness of the capital as a destination for capital?
I mean, I think you have to call a spade a spade. If you raise the specter of significant increases in taxes anywhere in the world, people get nervous. And I mean people at all levels get nervous. If you're going to raise the specter of more taxes, you have to show what you're doing with the money and why. And I accept, and I think we all accept, that there have been some black holes that need to be filled in over the last several years. What people don't want to hear is you kept collecting taxes, you didn't invest it back into the country, and it didn't grow. So you just keep more black holes coming down the road. The key that I think Labour needs to do now is to basically focus the world on their growth strategy, which they have said they would do. And I think that's exciting.
In terms of U Capital itself, I was reading about the deal, and we reported on it on Bloomberg in 2020, the loan from Goldman Sachs to U Capital, £875 million in 2020. Maturity perhaps coming up soon. Is that something you're thinking about,
always.
Concerned about?
I would say we always think about our capital structure way ahead of time. So we've got time. The loan was made with enough ample time to create buffer in the system. That's how we like it. But we're already looking at that now, and I think, frankly, we're in good shape.
And you're confident you can deal with rollover?
I think the lending market today has some question marks over it. I would say, relatively speaking, it has fewer question marks today than it did when we were placing the loan originally back in 2020.
A last thought for the budget and Rachel Reeves. What would be, your biggest ask, your biggest request?
Focus on growth. Focus the whole October 30th on growth. Forget sort of the past and what's been happening over the last 90 days of the $22 billion. Focus on how this country is going to focus on private-public partnerships to create growth, to create housing, to create jobs, to attract foreign direct investment, to make sure that we're opening up this country. I think the minute that she says that, the door is already open for all of those businesses to come in. They're just wanting to make sure that leadership is there to open the door. And as long as she says the door is wide open, I think she's going to find quite a good reception.
So, Lloyd Lee's warning coming ahead of the budget on the 30th of October, during which Chancellor Rachel Reeves will announce how she plans to fill that £22 billion hole in the public finances. The investors who spoke to Bloomberg Radio expressed concerns about tax changes. The British Chambers of Commerce says that the fundamentals of the UK economy are great, but it's, quote, fragile, conditions are difficult in their words. Their Director General, Siobhan Haviland, says that the small and medium-sized businesses that she represents are worried that when the Chancellor talks of those with the broadest shoulders carrying the burden, she might mean them.
The Chancellor needs to find the money she needs in the right places that don't impact economic growth. But she also needs to tell the story, the wider story. The UK is a really great place to start, grow and invest in a business.
That was the BCC Director General, Siobhan Haviland. And tax is of particular concern for private equity investors. Bill Curtin, head of M&A at Hogan Lovells, says that proposed tax increases in the budget are very worrying and that if there's increasing cost through taxation, in his words, it doesn't paint a pretty picture for private equity. He says how the budget is resolved is going to be a very important test of confidence in the UK. Here he is speaking to me and to Bloomberg anchor Tom Mackenzie on his view about whether the Labour government has delivered stability and has proved better for the UK economy so far.
I think it's too early to say. I think it remains too early to say.
So what's it dependent on?
Well,
the budget?
I think it's first we're going to see what happens with finance, right? We have a big question looming here in the UK on the budget side. I actually think the unemployment numbers in the UK, if you look at them, are very much in check. I think inflation now has come to a 3-year low in the United Kingdom, right? So that's very promising as well. So I remain hopeful for the UK. I think the geopolitical environment will be very important for this government, right? How we're going to deal with the Ukrainian situation. We now head into another winter there, right? What are the positions that the NATO allies are going to take for the United States? What's going to happen with the U.S. presidential election? How that impacts what the United Kingdom needs to do internationally will be very important also in the Middle East. So I think, Caroline, it's too early to say with this government. I'm very focused on what's going to happen with budget and how that gets resolved or unresolved, right? That's going to be very important in terms of confidence in this government.
Will it damage M&A activity if we see those non-dom tax hikes, if we see any other tax hikes, capital carried interest for private equity? Is that worrying?
It is worrying, clearly. And there's no ambiguity about that. Here's an interesting statistic, Caroline, in that regard. The hold period right now for private equity funds has eclipsed 7 years on their assets. Just a year ago, the trailing average was just over 5 years. It's now moved this year towards 7+ years that the private equity firms are holding their assets because of valuation gaps and the cost of capital, right? And so if there's increasing cost through taxation, interest rates and the like, then it doesn't paint a pretty picture for private equity.
Do you think that Rachel Reeves, the Chancellor, is listening to that sort of feedback from industry that is obviously getting more acute in the days that we get closer? Is she listening? Will it just be scrapped from the budget?
I think it will be difficult not to listen to that because of the forces, the economic forces behind that and how integral. Remember now, private equity accounts for more than 30% of business transactions that occur in this arena. And so it's very difficult for the ministers not to pay attention to those voices and to their concerns going forward.
Yes, that inherent tension, isn't it, between attracting those kind of investments whilst also trying to repair the balance sheet of the UK. In terms of when you speak to your clients in the US and elsewhere, and they're looking at UK assets, is there still a sense that there's a valuation play here? That you wait for some clarity on the budget and other measures, and then you put some cash to work? Is that the sense you're getting when you speak to clients?
Very much so. There's opportunity in the UK, and there's reason for optimism in the UK. But we do have a new government that's still playing out its story. And it's a affaire à suivre, as the French would say. We're watching and following as this unfolds. But there's certainly opportunity in the UK, and it's across multiple sectors here. And also with continental Europe, there's opportunity as well. Again, aerospace and defense. In the banking sector, there's opportunity too. The private credit market is very significant here. So they don't have to just go to the right. So private credit is increasingly germane to what can happen here in the UK. So there's reason for measured optimism, even as I said earlier, meaningful optimism. It just hasn't taken hold yet. And you remember with M&A, unpredictability is anathema. We like predictability. We can deal with all sorts, Tom, of predictability. Good predictability, medium, even bad. We just need predictability to know where we're going. And when you have a government that's been in power just over 3 months, it's hard for us to have the confidence in perfect predictability.
Yeah, and it's hard to find predictability more generally in this current environment, isn't it? Given what's happening in the Middle East, Ukraine, Russia, even predictability around the next steps in terms of interest rate cuts. We thought we knew what the path was, and now it seems that's been questioned.
And we have a U.S. presidential election and a congressional election and foreign policy that will be markedly different under the two regimes.
You touched on this. You talked defense, AI, banks. You touched on banks. You touched on the continent. I'm not going to pin you down on names, Bill, for obvious reasons. But in terms of this question around whether or not you see more banking consolidation, we've got this potential bid, UniCredit building up a stake in Commerzbank. Do you think that genuinely is a sector where you're going to see more activity?
I think in the regional... See, in the United States, we have a more regionalized system of banking than you have in Europe. So it makes it a little bit more difficult in Europe to see as much activity. And of course, there's the regulatory constraints that we face in Europe. So it's relative, right? It won't be as significant as what I think we'll see in aerospace and defense, particularly through the supply chain on the aerospace and defense side. But I do think you'll see some activity in the European theater in the banking sector as well.
Okay, that's interesting. In terms of AI, does it affect M&A in and of itself? We talked about AI coming for the jobs of traders, or, well, let's rephrase that, assisting in terms of pricing for things like foreign exchange, and therefore the roles of those traders changing. Is your role changing? Your industry changing?
It's a great question, Caroline. It's a tremendous question. We think about it all the time, and we don't have an answer to it, except to say that I don't believe anytime acute AI is going to tackle the element of judgment. And I think for trusted advisors who are dealing with highly confidential and highly consequential actions like big ticket M&A, you desperately need good judgment. So the AI piece becomes, Caroline, a facilitator.
Yeah.
It becomes a mechanic to make things more efficient. But I don't think it's going to take away the role of a trusted investment banker or a trusted M&A lawyer in the market.
But are you experimenting with it, with AI programs for efficiency? Are you using them? Is this, yes, you're not.
It is, Caroline, we are, because we're required to do so, because the clients expect us to pursue every means of increased efficiency. And so AI is now becoming part of our norm. The piece that I don't think AI will replace is the voice in the boardroom that says there's too much regulatory doubt around this type of transaction, or there's not enough financial confidence in the ability to execute this transaction. And I think the trusted advisor will remain very relevant.
So my thanks to Bill Curtin from Hogan Lovells there. Meanwhile, Michael Moore, the CEO of the British Private Equity and Venture Capital Association, is the top lobbyist for the industry overall here in the UK. Moore tells me the ideas from the new government are good, but the industry wants more detail, especially whether the Chancellor intends to boost the tax rate on carried interest, that is, fund managers' portion of profits on asset sales, whether that will go up to 45% or close to 45% from the current level of 28%. I began by asking the BVCA's Michael Moore whether the Labour government has delivered on a more stable environment for his industry after 14 years of Conservative rule.
Stability has been the watchword of both the Prime Minister and the Chancellor for the last couple of years. And of course, initially that was, dare I say, as a counterpoint to what they were suggesting was instability from the previous government. But it has to mean something. And now that they're in government, I think the key to it has been to really quickly establish that they're going to follow the kind of long-standing best practices of using the Office for Budget Responsibility to mark their homework when it comes to the budget, set out spending plans on the regular pattern, And I think that has, ticked the first of many boxes in saying, yeah, this is going to be done by the rules. It's going to be a traditional, dare I say it, small c conservative approach to all of this. And that does help give confidence that this will be a stable approach. As a starting point, I think people would say the move from opposition to government has been consistent and has set the stall out in the right kind of way.
Is there any evidence that the pledge to crowd in investment into the UK is working? Is it too soon? What evidence do you see?
I think this remains to be seen. We need to have the budget. We need to have the investment summit. We need to have the industrial strategy, all of those big bits of the jigsaw, not least the budget, to see if the good intentions and the strong messages are borne out by the substance.
Of particular interest to the industry that you represent, the idea of carried interest, of a crackdown on that particular benefit for the industry to increase the tax take for the Chancellor. Do you think Reeves will do it or back down?
We'll obviously see at the budget what the Chancellor proposes to do. But in recent times, her language, her approach has said things that give us, some confidence that she's entering the conversation in the right way. Namely, she understands the contribution the industry can make to growth. That's a top priority for her. And she has been setting out a little bit more clearly what it is she believes matters for carried interest, namely, that there's some skin in the game, some contribution from individuals into the fund.
Have Labour in government been too pessimistic on the economy and caused a hit to sentiment?
The confidence monitors and the like tell a story of people perhaps being wary at the moment. At the moment, we are dependent on the messaging about being committed to growth and sorting out, different aspects of the public finances. After the budget, I think we get to a crunch moment. Having said all that, the government continues to say a lot of the right things, but we can't live without the details indefinitely.
2 new public bodies have been created by the government, GB Energy and the National Wealth Fund. What do you expect from those organisations in terms of ushering in investment into the UK? Have they delivered anything so far?
Many of these ideas are still at kind of high-level conceptual stage, and we do need to see quite a lot more detail. Investors, international investors, certainly want to see them develop because the principles are important ones. Making it easier to allocate capital to the UK, have it managed and deployed in the UK is fundamentally important. It's a very, very competitive world out there. What we want to see is that we get the delivery on that and that we get slightly more straightforward ways to deploy capital into the startup businesses in the UK, the scale-ups.
Yeah, and so to return to the budget then, the temptation will be to raise what the government thinks might be £500 million or more per year from private equity individuals through this, scrapping the carried interest regime. Do you think that that's going to happen?
Having a capital commitment, skin in the game, is really important to getting some version of the existing treatment of carry to continue. All of that is been pretty substantively explored. So the idea of scrapping it, I think, is not what is there and facing us. But there's clearly a need to ensure that the government is satisfied that the approach is good.
Is there some middle ground whereby the share of profits made by private equity managers and how they're taxed on those deals, there could be a middle ground? Right now it's taxed at 28%. Could it be, rather than 45%, which is the top rate of income tax, something in the middle?
We've not been talking about specific rates. Nobody negotiates their tax rates or tax arrangements with the government in this kind of situation. But I do think and one of the things that the government asked in their consultation was, how does it look elsewhere? What is the international benchmarks against which the UK is competing? I'm hopeful that the really serious engagement we've had in recent times, the recognition of the value the industry creates, will allow us to get a solution that allows the government to meet its political commitments and its manifesto promises, and allows us to sustain ourselves in the UK.
So that was Michael Moore, the CEO of the British Private Equity and Venture Capital Association. So my thanks to all of those individuals for speaking to me ahead of what are two big tests for this new government, the Investment Summit and then the budget. And I just go back to what Anne Glover at Amadeus Capital Partners told me, that there has been so much speculation that no one has a clue what is actually going to land in the budget, which is unusual given the recent history of intense pre-budget briefings. 3 months into the new UK Labour government, many people in the city don't feel we can judge yet on their economic impact, but they do also want more clarity, more detail, the industrial strategy. And they are starting to get a bit more nervous about what Starmer and Reeves and their team can deliver for Britain.